Hi, good afternoon, everyone, and a very warm welcome once again to our 13th Logical Talk. Um, while last in the last session, we also spoke that was the 12th one, and but today in this month exactly we have completed 1 year of our new initiative of Logical Talk, wherein we bring industry experts for you every month to discuss on the topics which we are really concerning the industry. And during this last 1 year, we have covered a wide range of topics from dark patterns to dematerialization of shares to higher pension schemes or gratuity or ESG, CBLODR, BRSR core, so, and a couple of them on RBI regulations and requirements as well. And here we are back again with our webinar on RBI scale-based regulations, and specifically why we have chosen this topic at this point of time, because we are seeing RBI is getting very active right now, and the expectations of RBI is changing and increasing, and very often we are seeing a lot of new penalties, actions from RBI to ensure there is or rather, I would say that RBI is moving to a level where the tolerance levels of RBI is very low, and possibly they're moving towards zero tolerance. Uh, Rightly so, because the way I think the market is evolving, the way technology is evolving, and the threats are evolving, I think our RBI has to put the right focus for everyone in terms of the compliance as such. Uh, and Before we jump on talking, introducing to our guest speakers today, and I'll just take a minute to, and do my customary slide of introducing Lorbit to you all. I'm sure by now you all are aware of Lorbit, but we are a SaaS-based risk and compliance management solutions provider. Our solutions are being used by 300 plus enterprises. I think there's a slightly older slide in India and global, wherein our technology is integrated with the regulatory know-how about hundreds and thousands of laws, both in India and global, which has a massive library of compliances obligations which gets updated on the real-time basis. And today, every growing enterprise, every established enterprise needs to have a solution like this to ensure they are complying or they're on the right side of the law, because three things are constantly evolving: the businesses, the law, and the people. So in such a dynamic environment, gone are the days when things were slow. In such a dynamic environment, if a business has to last longer and has to continue growing without any hurdles, uh, it has to ensure that it is on the wrong side of the law. And that's where our compliance solution comes in. It helps you keep a complete control of your regulatory obligations without getting bothered about any non-compliances or any kind of a surprises coming from the regulators or from any non-compliances. Over to our speakers today. Uh, Anitha, thank you for joining and welcome to the webinar today. Anitha is the Chief Compliance Officer for Aptus Value Housing Finance India Limited, based out of Chennai. And Anitha brings a lot of experience in hand in dealing with RBI and the RBI regulations. You know. With in her current profile, as well in the previous experiences as well. Anitha, we'll look forward to hear your thoughts today. Uh, Jailendra Shukla. Jailendra is also Chief Compliance Officer from Agrim Housing Finance Private Limited. Jailendra brings around 18 plus years of experience, and he has a very diversified experience of working in different organizations on different sectors. And when I was talking to Jailendra, there were a lot of ideas and thoughts which were quite interesting. I'm sure his experiences would help a lot in in taking some of those clues in terms of how one has to be prepared and how one has to understand the expectation from RBI, and maybe a couple of pointers from both Anitha and Jailendra in terms of how practically some of these expectations are being met, because uh, again, I'm saying the world is dynamic, and the changes in RBI, I'm sure we all are encountering. They are happening at a very, very rapid pace. Before we jump in, I just want a small disclaimer that this webinar, this logical talk, is 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 to do an idea sharing, is to give a perspective basis our learnings, experiences, and sharing them in the industry. Uh, Whatever both Anitha and Jailendra are sharing, it is their own personal views. Their organizations have no role to, and there is it. It does not, in any ways reflect the opinions and advice from their organizations or from Lorbit. So during this discussion, I think let's make it more open-ended, and like we always do, feel free to write in between on the chat box if you have any queries, any thoughts. Our team will also try and keep addressing, and also we will try and take those pointers during the webinar itself. Trishul,
Thank you. Thank you so much. So I'll be sharing the agenda of the session today. So we will be talking about how the regulatory framework for NBFCs have advanced over the years. Erstwhile classification for NBFCs will involve systematically and non-systematically important master directions, and a brief overview about it. Scale-based approach regulation, where we'll be talking about how the NBFCs have been bifurcated into the layers and the type of NBFCs. A very short description about the types of NBFCs will be told during the session, with the common obligations for NBFCs, indicating very important obligations for NBFC middle layer and upper layer, along with the new features of upper layer. We have also have a calendar, the compliance calendar for the NBFC returns, which we will be sharing with you basis the periodicity. And also our team has collated the NBFC returns due dates, yearly, half yearly, quarterly. So we will share that link with you for your references. Also, with the penal actions which are taken by RBI against NBFCs, will be taken along with the expectations from the REs. So this is the agenda for today. So first, we will talk about how this has been advanced over the years. So if you see, we have started from 1964, where RBI was given certain powers to regulate NBFCs, and they inserted Chapter 3B in RBI Act 1934. If you see, RBI in 1998 introduced regulatory framework for NBFC, which broadly classified these NBFCs into deposit taking and non-deposit taking NBFCs. If we go forward, we have seen that RBI in 2006 introduced their set-based classification for NBFC. The threshold for defining systematically important NBFC was earlier limited to rupees 100 crores, which got revised to 500 crores in 2014. Again, in 2016, two regulatory directions for NBFC came, which was systematically important and non-systematically important. And we saw that over the years, now considering the NBFC was gaining the size and it became equivalent to the sizes of the bank, the increasing systematic importance, the regulator felt the need to review the existing framework, and they updated the prescriptions in light of recent scenario. So in 2021, if you all remember, 19, issued the guidelines, and under the framework of the same, scale-based SBR master directions came into force in October 19, 2023, and effective from the same date. So if you see these master directions, it established a layer approach with incremental obligations being assigned to each layer, right? So if you see the for ease of reference, if you see these it divided in certain sections, that each layer's compliance obligations have been it can be seen in this master direction. And in 2024, they announced these RBI, the master direction, RBI filing of supervisory returns, which has brought clarity we would say harmonization through the instruction issued to various supervisory entities for submission of their returns. So this is a part of series initiated by RBI to lessen the burden on these regulated entities, if we say in reference to the compliances. And this were totally, these regulations were recommended by the Regulations Review Authority and Internal Working Group of RBI. So that is how the regulatory framework for NBFCs has advanced over the years. So I hand it over to Anitha now to take up the next slide. Thank you.
Thank you, Ms. Trishul. And I would like to thank Mr. Jayant for, first of all, providing this opportunity to discuss with our community of CCOs in NBFCs. It is actually the need of the hour. Now that RBI is slashing penalties day in and day out across, it is definitely the need of the hour, and it is the right time to discuss with and share thoughts of all the CCOs in NBFCs. So now, over to the slide. What was the classification of NBFCs in 2016? That was prevailing until 2021, before the scale-based regulatory framework. The NBFCs were classified as systematically important and non-systematically important. The benchmark for the asset size was 500 crores. So any NBFCs that had asset size up to 500 crores, they were considered non-systematically important. Keeping this asset size aside, all the deposit-taking NBFCs, no matter what their asset size was, they were considered systematically important. RBI, considering the risk and the regulation that needs to be put on this regulated entities, they have considered this asset size as the only category until 2021. Only asset size was considered the criterion for dividing the NBFCs until 2021. Now that with the 2021 scale-based regulatory framework, now we have NBFCs in 4 layers. This came in 2021, and this was effective from 2022. So most of the NBFCs are falling under the base layer. That is 95.5% of the NBFCs, counting around 8, 9, 1, 12 NBFCs as on date, are falling under base layer. This comprises of non-deposit taking NBFCs having asset size of 500 crore and above, but below 1,000 crore. It's actually non-deposit taking NBFCs having asset size up to 5,000 crore. All the P2B NBFCs, all the account aggregators, non-operator financial holding companies, and all the NBFCs without public funds and customer interface. So basically, what is the motive of NBFCs in classifying the NBFCs based on scale-based are 4 items. The first one is asset size. Asset size, that is, they have made the benchmark as 1,000 crores. And the activity of the NBFCs, each NBFC having one activity is facing an amount of risk. Risk is equally proportionate to the type of activity. So the risk, activity, asset size, and the RBI's discretion. So RBI's discretion in classifying the NBFCs plays a lot of role in it comes to upper layer and top layer. So now when we talk about the base layer, as we saw, up to 1,000 crore asset size, all the non-deposit taking NBFCs fall under base layer. And when we come to middle layer, around 405 NBFCs, which is counting up to 4.34% of all the NBFCs, which is very minimal. These NBFCs have asset size of 1,000 crore and above. All the earlier, like until 2021, the non-deposit systematically in NBFCs with threshold greater or equal to 1,000 crore, all the deposit-taking NBFCs, infrastructure finance companies, housing finance companies, standalone primary dealers, infrastructure debt funds, and certain government-owned NBFCs. When it comes to government-owned NBFCs, they can either be in the middle layer or the top layer. They cannot be in the they can either be in the middle layer or upper layer. They cannot go to upper layer, top layer. Yeah. And then to the upper layer NBFCs. all the among the NBFCs, the topmost NBFCs with the highest asset size, top 10 asset size NBFCs are falling into this upper layer NBFCs. These are identified NBFCs by RBI. And again, apart from the top 10 asset size NBFCs, RBI also has few parameters based on which it will include certain NBFCs in this upper layer. Wherever RBI feels there is a need to regulate these NBFCs, they are put under the upper layer NBFCs. And when we come to the top layer NBFCs, it should ideally be empty. That is the idea. As on date, there is no NBFC that is falling under the top layer NBFC. When RBI feels there is a need to govern a particular NBFC with more caution and the systemic risk is going up, RBI might, at its discretion, regulate that NBFC under the top layer NBFC category. So that is all under this categorization. So
Yes.
going forward, Jailendra sir will clarify on the types of
just
NBFCs.
go to the previous slide. Just want to add what Anitha is saying. Under the mid upper layer NBFC, there are 10 NBFCs which is classified by the RBI in the September 23, and there are 5 HFCs which is also one of the category of NBFCs. So there are 5 NBFCs who are classified the upper layer NBFCs. So total 15 NBFCs who are classified by the RBI in 2023 as the upper layer. So 5 HFCs who are having significant influence in the market, significant presence, higher risk are categorized, need more level of reporting, more level of compliances, governance as like the bank. So 5 HFCs and 10 NBFC classify into the upper layer by the RBI. And coming to this base layer, the base layer NBFC, there as lightly mentioned is the 8912 NBFC are into base layer. Out of that, 17 NBFC, 70 NBFC classified into type 1 NBFC. Type 1 NBFC means the NBFC who does not access public fund and do not intend to do a public fund. The public fund definition is already provided by the RBI in their master direction, and they do not intend to have customer interfere as on now and the future. So they are classified into a type 1 NBFC. So base layer, they are always remain into base layer. So 70 NBFCs, which is purely into investment by their own interest. They don't accept public deposit. They don't have a public fund. They don't have any customer interferes or in going to have concern in near future. So only that and to add in this slide.
The government-owned NBFCs, they can either be in the base layer or middle layer, is it?
Right. So here, coming to the type of NBFCs that, so we know as per the scale-based regulation which was covered by the RBI into through their master direction in October 23. They have classified the NBFC in 4 layers, but now what is the classification based on their activity? We need a certain sectorial regulation. It is not only one regulation are applicable to housing, same regulation was applicable to MFI, same regulation applicable to infrastructure, debt finance. So we need certain direction, certain circular or master directions to them regulate the sectorial based NBFC. So the classification is there. We have a housing finance company. When the RBI took the supervisory power from the NHB, now they have classified housing finance company one of the category of HFC. So housing finance company is also part of it, which is by default it is classified into a middle layer NBFCs. So housing finance company from day one, from their registration, they are classified into middle layer. So they have to follow certain regulation from the scale-based regulation which are applicable to middle layer NBFCs, and also master directions separately issued to a housing finance company. So they have to follow both the master direction. The larger term, as Anitha is saying, around 95% NBFC fall into a base layer, and out of that, around 97 onto an investment and credit company. That company can do any kind of business activity based on their with the category of 50-50 test, or if they are not into a CICs or anything. The other main category is CIC, the core innovation company, the company who are doing the investment into the group company. Around 90% investment into group company, associate, and the income around 60% from their activities. Another major point is the microfinance institution, stand-alone primary dealer, P2P. Now there are a lot of NBFC, I can say fintech. Those they are approaching RBI for a P2P license. The P2P NBFC means they provide kind of platform, the technology platform or the kind of marketplace where buyer and seller, I can say the consumer and the provider of the fund or goods or services, they come to the platform and do the business activity. They are the peer-to-peer lending. Infrastructure finance or infrastructure debt finance, they are doing the huge amount of fund like a bridge, road, dam, a kind of financing they are doing the longer term, more than 10 years, 5 years of debt funding to the NBFCs. Account aggregator, the kind of NBFC who are providing the data access to a consumer data, a kind of account aggregator to the other NBFCs or the HFCs or bank or primary dealer, other NBFC, providing the information about the collecting and information about the customer on a financial assets or financial market. They are the account aggregator. So these are the many type of NBFCs. If I talk about the numbers, only I just give you a number. Account aggregators were 14 in the out of the total list of NBFCs, which are as on 31st March 2024, published by the RBI. And the CIC is 56 company. The major, I again say the major focus of the even RBI also on the ICC, investment credit company, which is comprised to 8,912 NBFC as on date.
Yeah. Regarding the NBFC factors, there was a meeting that was held by FIDC with the banks and NBFC leaders last week, Financial Institutions Development Corporation. So there was a proposal from the NBFCs to club NBFC factor into the investment and credit company category. So what was the proposal was, if you have a license under ICC NBFC, you can also do factoring business. You need not go for a separate NBFC factor license. That was a proposal, but yeah, this might come up in future from RBI if it is possible. Yeah.
So, based on the RBI notification in October 21 regarding the introduction of a scale-based regulation, and based on the master direction which is issued in the 23, there are certain obligations, or we can say the new things which need to be followed by all the type of NBFC or the layer of NBFC, middle layer, base layer, or even the upper layer. So there are certain disclosure which needs to be given by the company in their annual report. Now the company need to give more disclosure regarding related party transactions, loans to director and senior management of the company, and also needs to give a tabular form the number of complaints received from the customer, pending and disposal, and also the aging by number of days how the complaint get disposed. This is the new requirement, not only on website or not only their regular reporting to RBI on their annual report. The company has to disclose. Risk management committees, also there is a reference of formation of risk management committee from the KYC master direction. Many base layer NBFC were thought now this is for the middle layer, but just read a compliant master direction. There is the reference for constitution of risk management committees for all type of NBFCs. IPO funding, there is a prior to this scale-based regulation, there is no selling limit to funding the IPOs, but now the RBI come up with this one of the notification where they have selling the limit of the IPO funding by the NBFCs. And also there is the NPA. Now what happened that the prior to this skill-based regulation, there are the smaller NBFCs are having the 180 days and the bigger NBFC 90 days. Now they are come up to the one place by some timeline, some due date by when the every kind of NBFCs, bank, HFCs, they have to follow the only one I can say the due date or DPD to consider the NPA of the account. So the reporting to the CIC reporting to the credit bureau has to be suppose if I in the person having the loan from the one NBFC where my account practice at 180 days DPD, I am a regular customer, but I am same person taking the loan from the another bank, they classify me into 90 DPD. So my credit report does not give me a clear picture whether I'm a genuine customer, proper follow paying the EMI or not. So this is the one of the major issues where the RBI or many customer or even CIC facing. So by the timeline, by I think the 2026, all the kind of financial institution need to follow 90 days DPD from the customer and having the reporting to end. These are the one of the major changes by this skill-based regulation for a base layer NBFC. I think again, this is one of the very crucial, I can say, for the smaller NBFCs to raise their fund, net own fund by 27 to 10 crore. There are certain exemption was given like a P2P account aggregator or the NBFC who do not have public fund. I can say the public fund disclosure means what? If you do not have any kind of funding from the public or from the bank or anything, if you're only from your own capital, if you are investing into your company, that is on the public fund, meaning by the RBI in their notification in 2026. So raising the NOF by 10 crores by 27, there are challenges faced by many NBFC. We will discuss on later. So apart from P2P account aggregators or type 1 NBFC, they can follow the 2 crores of NOF. Rest of the company by 27, they have to raise the 10 crores. So major, yes.
There are two quick questions. One is the requirement of having a risk management committee. Now, can an NBFC have external people on the risk management committee, or it has to be their internal teams full time?
So that the regulation is not specify anything, but if you go through the master direction, there is certain decision, risk management or internal audit, KYC or decisioning making power cannot be outsourced. You can have the kind of invitees who can give you the some kind of thought, some kind of clarity picture, but the decision should be taken by the employee of the company or the senior management of the company. They are not having a voting power, or they are only supported you. I can say supporting group to a RMC committee, but they are not in power to take any decision. Anitha, if you can add something on that.
Also, the regulation is saying risk management committee should be constituted based on as per the Companies Act. So whatever is said in the Companies Act applies same to all the NBFCs with regard to this requirement. Also, when it comes to listed companies, they'll have independent directors. They are required to have independent directors in the NRC, so they will have. But private NBFCs may not have independent directors in the board. So there is the confusion as to whether we have to have the independent directors for NBFC private companies. As on date, though the regulator might insist in the level of independence, risk tolerance for purpose of all these purposes, they might want to have independent directors. But as on date, most private NBFCs do not have independent directors in the RMC for this requirement.
Okay.
There is no clarity on that aspect from RBI. Yeah.
Understood.
So to add a few things, yeah, Mr. Trent, you were talking.
No, you please continue because I had a follow-up question on this. Yeah.
Okay. So to add few things on these requirements, with respect to net own funds, as Jailendra said, by 2027, ICCs, MFIs, and factors should reach 10 crore of net own funds, and they do have a glide path. By March 31, 2025, they should reach 5 crores. That is, ICC should reach 5 crores, MFIs should reach 7 crores, and factors should reach 7 crores. And by 27, it is 10 crores. So RBI has provided enough glide path on this requirement.
Yes, agree.
And regarding NPAs, when they define NPA, they are very clear that entire arrears of principal and interest should be cleared. As in, for example, if a customer in a credit company, if a customer has 2 loan accounts with you, One is the loan account has no DPD, zero DPD, and the other account has DPD. That is he has outstanding beyond 90 days in one account, and he doesn't have any DPD beyond due beyond 90 days in another account. He will still be classified as a NPA. RBI is clear that the entire arrears, all the loan accounts, they should have zero outstanding. In that case only, he can be classified, he can be moved out of the NPA. That is the clarity on this.
Just giving now the thing is going more deeper. So just giving you thought by 24 this March 31st March 24, those NBFC who had followed 180 days norm for NPA, now they have to calculate 150. By 25 they have to 120. By 26 March 26 they have to follow 90 days also, and there's slightly change in the sub-standard. So for base layer NBFC, they have to follow 18 months for calculation as sub-standard. So once the account become a NPA, suppose for example we are on the this particular 25, so I have to follow 120 days. So after 120 days, 18 months, the account become a sub-standard. But for a middle layer, it is considered 365 days. Or 360 days based on your internal, how you calculate the year based on your LMS or LS, 360 days or 365, it is internal, which is part of your NPA policies.
Understood. That's quite interesting. In fact, that will change a lot of things for specifically from a base layer NBFCs, because declaring NPA obviously reflects very differently on your books and increase, challenge your marketability as well. Great, thank you. Yeah, let's move next.
Yes, next slide. So this guideline now, the thought process behind that to regulate the larger NBFCs as like the bank or the NBFC who having the lot of market, influence, the concentration risk, or a kind of a public fund involved into from the bank or NBFC. So RBI says we have to more regulation or more kind of a watch to the middle layer or the upper layer NBFC. So they come up with the certain new points which is applicable to bank, commercial bank or scheduled commercial bank or private bank, to now applicable to NBFC who are into middle layer. See, they have the new requirement for appointment of chief compliance officers. So they are the one independent person who have fixed tenure, direct reporting to MD or independent or audit committee. They do not involve any kind of business decisioning or any kind of role to play business related concern. They're only focusing on the chief compliance, who are the one of the bridge between the regulators and the company who are providing the information. So the company who are in middle there needs to be appointed chief compliance officer. Core financial service solution, the NBFC, they have to must follow the core financial service from the collection of EMI or account opening or related activities. Compensation policies for the senior management personnel or the director or one level below or two level below the board need to be approved by the compensation policy, and the policy need to be reviewed and approved by the board on annual. And there are additional disclosure, the additional disclosure of the assets moving, your tier 1, tier 2 risk weightage, leverage ratio, your LCR. These are new disclosure in your balance sheet. And also the NBFC having assets are more than 5,000 crore, they have to risk-based internal audit. Not only internal audit as per the Companies Act, or not on internal audit as per the KYC direction, but on the risk-based internal audit based on some methodology, some technology, or based on the number of risks associated with a particular product, particular department, or the customer facing. And also the disclosure or a kind of a watch by the company for a sensitive sector, like real estate, investment in mutual fund, or some kind of IPO funding or a startup. Many NBFCs are doing the funding to another startup NBFC. So they have to review the risk and the reward, or what are the number of risks associated with their investment. And there is the credit and innovation. Now, this particular point has been revised by the RBI through their master direction. They are now merge between the credit of the group company, like prior to this skill merger, single investment in single company or the group of company, they are now they merge. If you have the investment in single company, 25% of your total loans advance into one company, and a group level on 40%. So this level of need to be reviewed by the audit committee, need to be reviewed by the board. And again, the introduction of the Basel Norm 3, internal capital education and assessment process to NBFC need to be followed, have a robust system for overall compliances review, financial, internal audit, KYC, and all the operational risks need to be reviewed by one framework with the ICAP framework for the NBFC. Apart from this, there are certain things that the board of directors having a certain experience. Apart from this, the prudential norm, there's already saying regulatory concern, the loans to directors, granting loans to director, dear relatives, or advance to senior officer of the company need to be given more thing. And for the upper layer NBFC, that NBFC we have discussed the 15 NBFC and 5 HFC into upper layer, they need to get listed within 3 years once they're notified by the RBI. Suppose in September 23, there are a list of 15 NBFC and HFCs with a public. So by next 3 years, I can say 45, 16, 2026, they have to list it. By this regulation, I know that the one NBFCs, they have surrendered their license. They don't want to continue because lot of review, lot of data requirement. In every month or every quarter, the RBI people go to that NBFC, ask a lot of data, bank-like regulation done by the RBI to the upper layer NBFCs. So that level of compliance, that level of data integrity, data security need to do once you classify into a upper layer NBFC. Internal group, suppose you are a middle layer, so the group structure of your company, if you have multiple NBFC into group, you have a very clear defined agreement between sharing of the data, sharing of manpower also, not only the data, but the manpower. Suppose in the group, you have 2 NBFC, one person is doing activity for both the company. You have clear contract of sharing the information by the same person or having the dual role in the same company or the group company need to be very clear. These all for the upper layer. I think we have covered loans and sensitive exposure also. So
you know,
yes,
but what we're saying that there are a lot of these expectation in terms of their risk management, in terms of the compliance obligation. I think they are now in line with what is expected from the banks.
Yes.
Right. And slowly, I think RBI is also gearing up their upper layer, the middle layer, and the upper layer NBFCs to be be aware of what's happening, and specifically, I think deposit taking NBFCs, to the practices which have been followed by banks. Jailendra, any of your thoughts? Because specifically from housing finance company and deposit taking NBFCs. Now, what changes are you seeing in terms of their their approach towards risk? Because the way I would and definitely I've seen the way the banks take risk and the way they analyze the risk at the transaction level, at the KYC levels, they're their thought process and approach is very different. Now, how with this new set of expectations coming from an RBI, what changes are you seeing in a housing finance company and middle and upper layer NBFC, specifically the deposit taking?
So the approach from the housing finance company or a middle layer NBFCs are now day by day are increasing. Now they are taking a lot of help from the AI, the artificial intelligence or the data which is available from the other regulation like KYC verification through some of the third party. Use the major. I think the major issue the NBFC or HFC is facing are the one kind of platform where they can review the lot of data from the customer on the KYC onboard. So the use of DigiLocker, I think one of the major breakthrough in the KYC onboarding of the customer. The government, you can put the Aadhaar card, PAN card, driving license. If the customer having proper, linking with the Aadhaar, mobile number, and the bank account, then you can use the lot of services on a very affordable way for the DigiLocker. So these are the but you have to some kind of infrastructure to get the response from the DigiLocker and again the use of compliance reporting by the housing finance company also be taking very crucial role to sustain in the market, and also regulators are giving lot of other data point to check that housing finance company or middle layer NBFC to follow the proper guideline on the customer expectation, customer disclosure, transparency, and there are certain other I can say other public sector company or certain NGO who are giving the financial literacy to the customer. They are now aware more and more knowledge how to enter into a financial markets.
And while appointment of CCO is one of the mandatory requirement, which I think came out in October 2023. What are the expectations or change expectations now from a CCO?
So what is in my view, the expectation from the government regarding appointment of CCO is very high. They say a person who can aware about everything about the company, what is going on. Not only for the RBI regulation, not only for the NHB regulation, but apart from the labor law, your branches, support I have branches in the Coimbatore, I know what is happening in the Coimbatore. I have to understand whether the branch is doing the proper display of the policy, proper taking care of the customer awareness or explanation to that. I have to know what is going on the GST portal, everything on the other income tax related. So they need a kind of person who are not kind of my person. RBI say I need one person who act in the company on my behalf. He are not bothered about the business or raising 10 crore AUM, 100 crores of AUM. I need one person I appointed giving the power to act as a CCO. So he is my watch eyes who can review the company on independent way and giving more weightage to audit committee. He is giving his report what is right, what is not right. This is a red flag, black and white picture to the audit committee, and now responsibility of audit committee to explain to the board and all. So I think CCO is the one of the eyes of the regulator who are into the company. So I always believe the CCO should be 100% independent. They are not giving any kind of business role, any kind of sort of some conflict of interest in his work. He will review each and every para, whether it is business, credit, operation, disbursement, NPA, fundraising activity, whatever. He's just person who can everything review based on the master direction and give his reporting, whether it is right or not, to the audit committee or to the regulator when the inspection is come.
Understood.
But what I aware from, if I can say, from market, still there is, the RBI, the expectation that RBI is having from the CCO is not fully met. Still, there are a lot of NBFC. They only for ticking the box that I have appointed the CCO, but they either company secretary in the company, either internal, either some other report, or either not at that level the RBI want. It must be one level below the directors or even certain kind of experience in the financial, certain kind of understanding for the law regulation, not only from the RBI regulation, not only for the NBFC, HFC regulation, but also from the CIC, CKYC, NESL, IU, the other part of business activity. They have to understand and give either a fair view or flagging the red flag if anything not as per the RBI master direction. So still, I think still having a road ahead to give more power to CCO.
No, I think that comes with our understanding in the past from a company secretary's role, who was appointed as a compliance officer. But we all know how what the regulator expect and what on real grounds is are the powers of a company secretary. I think we have to evolve in our understanding and our and the role we have to give to a compliance officer on the board. Yeah, that's true. Interesting. A little bit interesting to watch, because at least if financial service sector, they start, or rather, I would say the large organization, it already happens. That company say, the risk officer has a say in the board, and they can challenge the decisions as well. But I think a lot of safeguards also. I think RBI has to provide to CCO, so that when an independent voice has to be there, that voice should be protected as well.
Yes, 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 I agree.
That'll be interesting to watch how really it happens.
Yes, that's why I'm saying the CCO is one of the eyes of the regulator. If you read the master that notification where it is mandate for middle layer and upper layer to have CCO, they're very clear protecting the CCOs. You cannot remove by the prior approval of RBI is required. If you remove by the before 3 years of their term, you have to do this, you have to report this. So it is giving certain kind of power to CCOs also to protect his right. Not only for the sake of compliance also, but his personal security in the organization is also protected by the RBI. This leverage, again, the leverage requirement or the different standards provisioning. It is also mentioned the standard asset provisioning on standard assets, internal exposure limit setup, the important sector credit to whom you are giving. Removal of independent director. Now we have the very well like the SEBI LODR saying you have to intimate the Reserve Bank of India prior removal of independent director. Again, unlisted and we need to draw a board approval roadmap for complying with the listing requirement by the within the 3 years of their once the NBFC get notified and to upper layer NBFC, the mix of qualification not only by the board but also the senior management people also having if you are the NBFC into upper layer sector. So Anitha, you can take this is the Anitha is saying out.
Yeah, I'm here. I have some issues with the camera, so I'm here.
No issue.
Yeah. Recently, they are very short time back, we received the supervisory returns master directions, especially for NBFCs. They have given some. This is actually not a complete revamp of the returns, but with few changes. For they've given reference dates. Based on the reference dates, periodicity, the deadlines will get deferred. So in this, there is one written called Financial Soundness Indicators. Regarding that written, we received email. All the NBFCs received an email that it is not applicable for NBFCs. However, this was part of the written. I think in the chat box there is a link that is shared made by Norbert providing the due dates. That would be more useful for all the participants here. So there is a new requirement on acrylic weekly. There is for the large borrowing details returns. There are two returns. One in 1 month and another in 1 week. So they have given us main acrylic and acrylic weekly return. Trisha, can we go to that link that is shared in the chat box?
Sure, Anitha, I'll share that.
No, give it. All the quarterly returns are filing due date is 21 days from the end of the respective quarter, and the monthly return is the within 15 days of end of the specific month of the reporting. So suppose if I file for the quarter ended March 24, the quarterly return due date 21st April. If I file the monthly return for the March 24 month, the due date is the 15th of April, and like on. This is already placed in. Now you can see the presentation where it is clearly mentioned. So here is also this data not only for NBFC, it is also compiled the HFCs also. So the HFC return are quite different, and also the reporting portal for NBFC is the CIMS portal, and for HFC it is the CRAMIS portal. So HFC, those who are registered with the NBFC, but earlier they received license from the NHB. Now they take a fresh license from the RBI is just only a 9. They have to file their return monthly, quarterly, half yearly, and annual return on the CRAMIS portal. And all the other NBFC, normal pure NBFC, they have to file on the CMS portal, which is now just newly introduced by the RBI. So you have to start filing on that portal. Just one update, I think many NBFCs have received the email after this master direction of supervisory return, which is available in February 24. They say the DNBS 02, which is filed by the base layer NBFC, it is become quarterly from the annual. But the infrastructure that the CMS portal or the utility is not changes as the master direction has been published. So the RBI advised through their Department of Returns or through the emails that for this particular financial year, for this particular quarter, means for March 24, you have to file as annual, and as and when the particular utility or the CMS portal get updated, the return become a quarterly. So within the 21 days of end of the respective quarter, you have to report. So this is one of the major, I think, say the challenge for a smaller NBFC to prepare a quarterly balance sheet and reporting within 21 days of end of the month. This is one of the major changes for a base layer NBFCs who have been, as you can say, base layer or smaller NBFC means 50 crores of asset size or 100 crores. Preparing a quarterly balance sheet is quite difficult for them. So there are a lot of
in this from this direction there are only 4 changes. For DNBS 2, the earlier timeline was annual timeline within 60 days from the reference date, but now the revised timeline is quarterly within 21 days from reference date. For DNBS 4B, earlier it was within 10 days from reference date. Now the revised one is within 15 days from the reference date. And for the acrylic main return, within 21 days from reference date earlier, now it is within 15 days. So when you look at the earlier and the current timelines, there are very few changes only with respect to the timeline of 21 days or 15 days. And the returns 1, 3, 4, 8, 7, 11, 12, 13, and 14. Earlier it was 15. Now it is 21 days from the reference date. This is in short about the supervisory return master direction.
So, and Trishul has also shared a link on the chat box. I'm sure this is going to be very quite handy compliance calendar for all of you. You can bookmark it. We can keep this link handy with you. And we keep updating as and when there are serious changes are happening in the or I would say permanent changes are happening in the compliance filing requirements or any new expectations. So I think this will be very handy if you do not have if you have not implemented GCMS to manage your compliances. This could be quite a handy tool for you.
Yeah. So the one giving an insight about this for a base layer NBFC or for a smaller NBFC. When you prepare to file DNBS 02, the return is quite different how you prepare your balance sheet. Many NBFC, what they have the give you the exact loans advance. Certain time they include their balance into a trade receivable, not classify the loans advance in their schedule or in the face of the balance sheet. Many times the provision on the standard assets or provision on the substandard, they directly deduct from the loans advance and not on the separate heading into a separate kind of schedule into a balance sheet. So when you start filing the DNBS 2, you have to end up with receiving an email or concern from the RBI. You have not properly disclosed the provision on standard assets or provision on substandard assets and proper classification of outstanding loans into a loans advance schedule, not in a trade receivable schedule. Many NBFCs are smaller who are of tier 4 or tier 3 cities or some of the rural. They classified all their loans into a trade receivables and not in a loans advance bucket. And also the disclosure is secured and unsecured. They are only mentioning the loans advance in the proper balance sheet. So it is very difficult by the RBI also to classify, and then they have received a kind of email or a kind of warning letter or caution letter why your balance sheet does not have a proper disclosure. So only you need to just understand the Schedule 3 of the Company Act. Just review the read the disclosure requirement from Master Direction of Skill-Based Regulation for the base layer. They have given the list of items which are the mandatory to have into a balance sheet and a schedule B. And then you have to be able to file it DNB 02.
Mr. Jailendra, so there is a question for you. Mr. Krishnan is asking for a CIC. Only CIC master direction to be followed, or scale-based regulation also would be applicable?
Yes. If you read the CIC master direction, in many times they have to please refer annexure number so and so of scale-based regulation. For a sectorial base, you have to read your own master direction, which is available for the CICs. But under the CICs, the regulation RBI is, that's why I say one of the regulator which I almost blindly believe their notification is the RBI. They publish their master direction, master circular, or notification, giving the reference to the other regulation, whether you need to follow the same from the other regulation also. If you read the CIC, they in a number of places they give you the link. Please read this. Please read that is the circular of the KYC or from the skill-based regulation also. So your main Bible is CIC master direction. The cross reference it is already given into the same direction.
It's like more similar to HFCs. Like it is HFC directions is applicable. Scale based is also applicable.
Yes.
It's a similar case.
Okay.
Yeah, so this is the where now we have talked the company have to need a lot of compliance to do. We have to do this activity. You are base layer, middle layer, but we are Indian companies. We are not much thought to have a compliance. Or certain time compliance are in such a way the company wants to comply, but because of certain infrastructure constraints, certain manpower constraints, and the cost. These three are the major role where the NBFCs fail to compliance with the RBI master direction. So by way of penalties or by way of caution letters or through the supervisory action, RBI intend to say, boss, you have to comply with the direction, whatever manpower you have. It is not that we want, suppose we have given, if you are not unable to comply with the direction, then surrender the license. That's why by 27, they had to say mandatory, you have to 10 crore. Unless until you don't have fund, you are unable to set up the KYC master direction. You are unable to report the KYCs. And if you are NBFC, I give you the license to you to run a specific business where the customer, public fund involved, customer interest involved, and whole economy is depending on you. After the bank in the rural sector, after the bank, NBFC is the either any kind of NBFC. We can say NOF, P2P, or fintech NBFC. They are booming. Where the bank cannot be approached, the bank cannot open the branch. The NBFC having the branch. So you are not considered as the giving of some kind of leeway or some kind of free hand to do whatever you want to do. So RBI through their action, they have to say or kind of warning signal to bank, boss, you have to comply at any cost. The major focus, or we can say last 1.5 years, the major area where RBI sees the kind of failure or non-compliance, the main is the KYC. KYC through digital KYCs also or traditional face-to-face KYC. KYC direction or master direction on KYC, the many NBFCs failed to review. Many NBFC cannot having the proper compliance to the KYC's master direction. Customer grievances, sharing of the data with the CICs. Many NBFCs still they are unable to share the customer credit information to all 4 CIC within the defined due date and within the proper how to report it, proper information of their overdue, proper information about the DPDs of the particular loan or multiple loan having the customer, they cannot be classified proper in their report. Failure to do Aadhaar masking, the misusing the Aadhaar or misusing the KYC of the customer multiple times. There are very large NBFCs in the northern state of India. They have penalized for the non-compliance of the KYC. Adequate credit appraisal. Many times if you are doing the CD product, loan against, take the mobile loan or a refrigerator or a kind of two-wheeler loan. The credit appraisal of the customer is not properly carried out by the NBFC. They are a FOIR or the LTV against the some vehicle or something else which is not properly calculated by the margin funding. We are doing the some bill discounting or certain margin funding in terms of gold loan or in terms of loan against property need to be more accurate, more compliant, define the parameter. Risk categorized by the customer low, medium, high based on their profile, based on their job, based on their credit thing, need to be reviewed quarterly, and also it is reviewed quarterly by the company, need to place in a board meeting of the company. Also proper disclosure of charges in a loan agreement or in a sanction letter. These are the one of major area where RBI penalized the NBFC for non-disclosure of APR, annual percentage rate, or charges. What are the kind of charges NBFC going to collect over the period of time need to be first disclosed in a disbursement memo or sanction letter or the loan agreement. These are the charges. Many NBFC, what I see, the RBI is come up with the inspection. They having just one example. Suppose we are the vehicle finance company, we say the towing charge as applicable. But there is no limit. You have to define the limit. How much towing charge you have to collect when the asset get repossessed by the company. You have to give certain limit. You cannot open-ended. It should be, I don't know from where you, as part of RBI, as a customer, if you are repossessing my asset, I have to know prior to signing the loan agreement how much charges will you include or the legal charges. I don't know which lawyer you have to, suppose you tell legal charges at actual. If you are having an A+ lawyer, they have charges anything. Suppose I'm into some Chhattisgarh or something else, and you taking help from some Mumbai lawyer having charges in the lakhs of rupees. Why should I pay? So these are because on the basis, I not say you can have any lawyer, but from a company who are operating in a 4-tier city or some rural area, the charges should be as per the market standard on that particular thing. It not be open-ended. So these are the thing under again the fraud reporting. If you are having a 1 lakh rupees fraud, then you have to report to the FMR to the RBI. But below that, how the information of the fraud, how the information about the anything else needs to be submitted to the RBI, and their quarterly returns also need to be submitted. Many times the RBI penalizes the non-filing of the supervisory return like DNB 2, 10, or the 13, or any other 4A, whatever the return is applicable to your company. Properly not classify the account under NPA. Anitha is saying, so once account becomes NPA, unless until entire due is recovered, you cannot be classify account as a standard. Suppose if my 4 EMI is pending, and you collect 1 or 2, and you classify me as a standard asset, that is the wrong activity. So these are another one of the major issues where the penalties imposed by the RBI. I just yesterday. Just RBI published their annual report for the financial year 23-24. If I saw, just from that report only, in that particular financial year 23-24, 22 NBFC were penalized by the RBI. And the amount is 11 crore 53 lakhs. To the number of amount that RBI imposed by a penalty on NBFCs. And there are 3 HFCs also where the penalty is 8 lakh rupees. And the CICs penalty is around 1 crore. So it is something around 13 crores of penalty imposed by the RBI in only one financial year for NBFCs and HFCs. So this is the way, and not only it is not only for NBFC, it is from across all the sector, public sector bank, private sector, foreign bank, small finance bank, and rural regional banks also, cooperative banks also. So it is because of the increase the level of compliance, because the increase of level of the information flow across the regulator, it is very easy for RBI to collect the information. And the NBFCs or the financial institution, the company need to be understand why the compliance is more required apart from a business. Business is also there. There are certain things you need to comply. You need to do proper justice to the master data which is issued by the company, issued by the RBI. You have to follow it. at any cost, but there is certain way how to mitigate this. There is certain disclosure. If you do it today, it will not harm you tomorrow. Don't postpone the things tomorrow. If we will done it tomorrow, we will done once the regulator come for the inspection, when the RBI is coming for the review, I will do that day. So that was not the thing. We have to do it now. Either we can say do it today or do it now. The compliance is there. You have to do it now at any cost.
Yeah.
So,
To add a little more to whatever Jailendra sir said, as we all know, RBI has been slashing penalties left and right. RBI is also very clearly communicating what it is expecting from NBFCs. NBFCs should be compliant, not just in letter, but also in spirit. NBFCs cannot do anything that would put the customer at a disadvantageous position, or do anything that would put the business, that put NBFC in an advantageous position. Both the ways, the customer's interest is only the most top priority of the regulator. Whatever things that are coming under this are the disclosures regarding charges, like what Jailendra sir said. You just while you disclose the charges in your MITC, in your website, in your loan agreement, it is not just enough. You have to communicate the changes in charges that you're doing. Recently, there was a penalty for not communicating the charges in vernacular versions. That is also important. When we see this situation, communication of charges is just a compliance in letter. When you communicate charges in vernacular versions, it is compliance in spirit. So RBI is not just expecting you to comply with the regulations, but also comply in spirit with the regulations. Over and above what is required in the regulation is what is expected. And also the other area where RBI is focusing is tightening the areas where risk is prone. For example, outsourcing risks, third-party risks, cybersecurity risks. Cybersecurity risk is a lot more threatening when it comes to fintech NBFCs or large NBFCs. Cybersecurity is most emphasized on during the last conference that was held by RBI. RBI has listed out a lot of expectations, concerns on what is being prevalent in cybersecurity area and what is expected from NBFCs on this in this area. So RBI is just requesting by slashing penalties. It is just a communication and a warning to all of us that we have to do compliance right at the moment and not delay it. And also, it is emphasizing on sustenance of compliance. It is emphasized in a lot of conferences and speeches of the regulator. You have to comply and continue the compliance, not just leave it.
yeah, I think rather, Jailendra, this is my question to you. Now, being a middle layer, upper layer, NBFC, specifically when I'm dealing with a client and the consumer data, how do I ensure and what challenges do you practically face in terms of complying with the new regulation? Because as Anitha specifically mentioned about cybersecurity or outsourcing requirement. Now, being a large bank, I may have the flexes and I may have the muscles to be able to comply with those requirements, or I may have the bandwidth to do that. But how do you do that? I know what challenge you face, because a bank with a huge IT budget. I was just looking at some banks, and they have 1,000 crore IT budget, and my NBFC's total revenue would not be 1,000 crore. Which, and how do I ensure I match up with the requirement of an
Yes,
RBI?
that's a right question. In my opinion, for the banks, the risk is huge. The compliance requirement is also huge in proportion to its size. So the cost associated will also be huge. While when we look at baseline NBFCs, a small NBFC having a shortfall of resources to meet with the stringent compliance requirements, um, the cost that would be required or resources that would be required to meet with the compliance requirement in proportion to their size will also be commensurate. So we cannot just be saying, I'm a small NBFC, I cannot do this, that, and we cannot fool around with the regulator, is what I believe.
Right. And also there's challenges. See, many times like new, notification issue, almost I can say 80 to 90% RBI give you the timeline around 6 months or 3 months, certain time, more than that. And by this day, you have to comply with this direction. And in between the time, you just break the minimum level of compliance because considering your manpower or equity or fund or working capital fund with the company. But certain time it is you also understand by the companies also why this regulation or why this notification issued by the company. If you're not doing the activity which is already mentioned in the company's master direction, then the RBI, by their experience of inspection, on-site inspection, they come up some of the activity where the NBFC are failing to do, then they issue a notification. The example I can give, the latest notification in the month of April regarding fair practice code. Regarding the check issue, once the disbursement is done and the check
fair
issue,
practice code
you
is the big
start,
issue.
you start your charging the interest or the charging interest on the front full day, full month, not on the broken period interest. Suppose my disbursement happen on 20, I have to liable to pay the broken interest EMI on 10 days only for that particular month. But the NBFC what basically what was the smaller NBFC, they are charging entire month interest. And also the check, when the disbursement is done, check is not issued or not hand over to the customer, they start charging the
they start charging from the date of the
and
check.
they're just saying this is a post disbursal document, this is OTC, that because the customer not aware much more thing, because not aware what the meaning of this or what is the PDC, what is the OTC. So because of the sometimes non-activity, non-compliance or certain market practice which is unlawful carried by the some of the NBFC, the RBI has come up with a strict rule by way of notification. If you follow the master direction, there is no lot of things or strength compliance or notification by the RBI. Coming to the question, how this smaller NBFC or HFCs are face the issues in terms of the KYC compliance, in terms of the customer grievances, it is quite difficult. Doing the business, doing the carry out the manpower cost or actual mandatory costing, and in say the compliance costing also nowadays are increasing. So it is quite challenge on the technology front. On the front of the skilled employee who are aware about the compliances. There are two major. One is the technology, and second, the major issue is skilled employee who understand the compliance, who understand the market regulation, how the thing is going. Because I know some of the company having the operational head who are not yet doing the lending business in entire their career. Now they are come as the operational head. So they don't know how the pain of the customer having or what are the major issues which the customer is facing, and they come up with a lot of other thought process. The vernacular language disclosure. Suppose RBI says you need to do a sanction letter, KFS or a MITC or a schedule of charge in a vernacular language or the language understood by the borrower. It is easy for a smaller, bigger company, banks to do multi-language printing of MITC, multi-language printing. It is very easy. But for a smaller NBFC who have printing on Word and Excel, it is very difficult to convert the language into Hindi, Marathi, Gujarati, Kannada. So, but to overcome, before you reach a certain level, you have to come on kind of proper disclosure, and you have to you have to justify to the regulator that was at the time of loan sanction or at the time of loan disbursement, my employee of the company has explained everything to the customer in their language, and we have taken the disclosure, we have taken the declaration from the customer that they have understood in a proper language. And in that, many customer company, what they do, they prepare a disclaimer in English, and the customer sign into Hindi or in Marathi or Kannada. the disclaimer should be in, at least one page should be prepared in English that I understand the KFA
Yeah, this
charges, each and
disclaimer can be
everything.
part of the
In,
loan agreement.
yes, sorry.
That's a right idea. This disclaimer for vernacular version can be part of the loan agreement, can be part of the application form. Yeah, we can do that.
Yeah.
And
So yes, for a
in
small company, it's very difficult to them to prepare entire loan agreement, entire sanction letter in a multiple disclosure. English is normal; they can do on a LMS or through MS Office. So, but the RBI is not saying, oh, okay, boss, you can deploy your entire fund into this only. No, but what is the way out to come up with this? You have to take a proper disclosure, proper disclaimer, or proper declaration from the customer. But it is not on English. The disclosure English, I understand the rules are signed by the English or signed on the thumb impression. It should be their own language. At least one page should be their own language, having the proper customer name, their KYC name, the name of the person who explained to them. It is also very important. It is not a keep blank. Many NBFCs, what I feel, even HFCs also, they just take a customer, they come a lot of bulk of a document around 50 to 100 page. They say just sign on below. Everything is blank. They're not even to fill up the thing. So you have to fill the information. You have to fill each and every document, each and everything. Then take a sign of the customer. Give one copy to the customer at a time of disbursement or as a part of welcome letter, and take a proper consent that he has read, understand the schedule of charges, consequences of NPA, consequences of non-paying of EMI on time, or any other thing which needs to be explained to the customer needs to be done on the date of disbursement or within 1 or 2 days when you submit the welcome letter to the customer. So these are the minimum thing we can carried out by the smaller NBFC to, I can say, at least compliance to the RBI direction, and slowly they increase. Once you come to the one level, it is very difficult to clear your past thing and all the things. It is very difficult. So compliance should be from the day one. You start one culture of the compliance from your branch, from your just day one when you receive the license, and slowly you will not able to find any kind of costing of the compliance. It will become very easy to your business success and everything followed by that.
Yeah, complementing to what Jailendra sir said, uh, the timeline given by RBI to comply with certain circulars are reasonably good. For example, for the KFS, we have 6 months in hand to comply with just additional disclosures of KFS, APR, repayment schedule, along with the sanctions, just additional disclosures. And we have enough time of 6 months. That is one thing. And the other thing is what small NBFCs can do is um, they have to comply with the requirement to their utmost capacity that can justify to the regulator. Regulator is not unreasonable. He is definitely reasonable, and a learned regulator, he will be he will also expect what is there in your capacity, in the small NBFC's capacity in relation to compliance. So that is what is expected. The expectations are not unreasonable.
So just adding here, the many small NBFCs are not understand proper what is need to be done. If you the new NBFC, when you receive the license, RBI give you one kind of booklet around 10 or 20 pages, very specific. What are the activity? What are the compliance you need to do? If you just follow that 15 or 20 points, you're around 90% compliance. It is come with your license. One separate booklet from your license. It is come at 20-30%. What need to be minimum thing you do. If you compliance to that, and that is not very big thing issues or nothing else. And apart from this, just for sake of NBF smaller NBFC what does not have a proper manpower or trained staff, just take a help from some of the professional, some other company like anybody who can explain you the requirement from the KYC point of view, requirement from the skill base, requirement from the returns, or requirement from the data sharing with some other third-party government agencies. It is give you the clear picture where you are facing, because they have, see, As when it comes to business, they say, no, I do this, the marketing, I do my, they have the fund for that. But as a part of when it comes to the compliance, they say, boss, I'm a small NBFC. So these two things cannot be run parallel. Na? If you are doing a lot of opening the branch, opening the PR, you have the higher cost of business or credit or everything, then you have to do certain budget for compliance also. So this will save you from the your goodwill, your eyes of the your company can be safe from the eyes from the regulator. Once you penalized by the regulator, now you are considered a watch list. So every time the RBI will watch on you whether you are doing proper or not. So also there are one thing which I add here, the requirement of internal audit or concurrent auditor. If you read the KYC master direction, something around para 8 or 6, it is there. They're not defined layer or anything else. Means every NBFC need to have internal audit or a concurrent audit for the KYC and ML direction. So these smaller thing need to be reviewed or need to be properly read the master direction and then try to implement as much as possible.
Yeah.
So you will say from the
the summarized expectations of RBI are very few things. Sufficient documentation, and the documentation should be bona fide. There should be sufficient infrastructure to sustain your business. There should be automation, no manual intervention, and for the security. Yeah, the security should be strong and it should be resilient. The business's resilience is most sought after by RBI in the recent days. There's also a circle on operational risk management and resilience that is also emphasizing on risk and the resilient approach of the business. Uh, Most important out of all is this customer's interest, transparency with the customer. The business should do what has been agreed with the customer. There should be utmost transparency in the relationship of the business with the customer. That is all.
Yeah, so I think I just want to add a couple of pointers here. See, I think the way the financial business is evolving today, uh, it's getting much more complicated than what it was earlier. Uh, Both in terms of the way money flows, uh, you know, and the way money is managed. I think RBI is one, keep trying to keep a very strong clear eye on that. Second, the advent of technology in it. Now, when the technology has got mixed with the financial services, it is making life much easier, but it is also increasing a lot more complexities. Looking at the number of frauds and the amount which goes into fraud is running into thousands and lakhs of crores on an annual basis now. Now, RBI in this environment will become more and more stringent, and it is very well understood. Challenge, because again the way business is expanding and the way our economy has expanded in the last 10 years. The Jandan accounts, while people, there was a time when nobody was even thinking that they will get a loan. So today there are people at every level who wants to get a loan. Now maybe someday the banks are not giving, and obviously they are moving to NBFCs. And now that's creating a business opportunity for a microfinance company to open up um, and provide a loan now. But at the same time, microfinance company doesn't have the flexibility as a bank would have. But the expectation to safeguard the interest of a small, retail individual in a tier 2 or a tier 3 city or a smaller village is also, is similar to what somebody with a higher net worth or a larger pockets could be. Now that's what the RBI's expectation is. Now, if I really look at, and that's something which I'm sharing based on my experience and a market understanding, not to go with, not to say something what RBI says. I think what we all have to understand how the business curve is. I think over the last few years, we have seen a tremendous growth in the NBFCs, and if you really look at, there are 8,500 odd NBFCs in the middle, in the base layer right now, 500 odd in the middle layer. This growth is going to be there for some more time. Beyond a point, like any other market, it'll reach a saturation and it'll lead to a consolidation. Now, if organizations don't take the right measures at this point of time, the party may not be very long. So, and unlike any other business, this is a highly regulated business. I'm saying is worldwide. If you look at the financial services business, or BFSI is the most regulated business. And if you really look at, because I'm in the risk space and compliance space for a long time, and we understand the space well. I think the amount of expense and amount of investment, and I would use the word investment, which happens globally in the space of risk management for financial sector companies is higher than any other sector. The financial sector companies is the biggest, or you can say bank or financial service, insurance, healthcare, insurance or housing finance or anything, right? The kind of spending they have in uh, uh, in risk management, usage of technology is phenomenally high. I think we have to start understanding this. And if we start understand it, and being a compliance officer or being a part of compliance team, we have a very important say in the board, in the discussion right now. I think we have to keep highlighting it. At times, right, the board may not, again, I would say, being an upper layer, being a bank, it's very easy to say and get certain things, but being a mid layer and the base layer, and today, fortunately, we've been interacting with all levels. I can only say that at times it's very difficult to make make everybody understand and buy the thought. But we have to be consistent, and we have to understand that this is a requirement of a business. And if it has to happen some way, it has to happen. And I think we have to, we have to just understand it. And also, one aspect is, I think we'll have to also open more and more channels to leverage each other's knowledge base. I always appreciate the chartered accountants, the CAs, everywhere. They have very good network wherein they do idea sharing. I think those networks and those channels, I think we'll have to open. We'll have to be more vocal in those channels to share ideas and thoughts, because there are some small things. Like one thing which I definitely see Jailendra bringing in, and Anitha bringing in this discussion is their understanding about the base layer and the middle layer NBFCs, because at the ground level, understanding these challenges and actually being able to address how to address, because Jailendra very beautifully explained how it is difficult to convert it to vernacular language. If I'm a bank, it's easy for me because I have much money, many resources. But if I'm an NBFC, small NBFC, for me, because I cannot use Google Translator for everything, because it may or may not, give me a right, understanding. So going and understanding those challenges and sharing how we are overcoming that, I think that's something should be done more at a platform levels. We are happy to engage more. Jailendra, your concluding thoughts.
Yes, I just want to add here. Also, I think RBI has sort of just to elaborating you what you say. RBI also need to have some platform, or need to have some kind of a workshop or certain kind of seminar where the regional office or small NBFC have come up with their issues or come up with a certain kind of clarification they need to ask, because it is very difficult to understand for the smaller NBFCs or for a person who are not proper having a skilled or anything to understand or review or the thought behind the notification. Certain times there is certain intention of the RBI, but the interpretation done by some other people who are not as the interpretation or the intent behind the notification. Why this regulation is issue? Why this KFS requirement has come up? Why this vernacular language is come up? If many people, why I know certain business are saying, if the some small sabji wala is able to do the mobile or having a bigger smartphone or do the UPI transaction, why not they do my EMI or anything? But you cannot assume it. It is a customer; they have rights. And as a regulator of the financial institution, I think they also need to regulate certain things to just say why this notification required, what the intent behind this regulation. I think RBI should organize certain kind of seminar or technical workshop or certain thing on annual basis or some periodically, which is help the smaller NBFCs or certain NGOs or certain like your kind of a company law or bit or certain, they come up with certain kind of workshop for smaller NBFC where they come up and say, I want to do the compliance, but I don't know from where to start. I don't know how to read it, how to prepare this KFA. I don't know how to calculate the APR. I know only ROI is 10% divided by 12 and divided by some PMR formula on Excel. I know this is my EMI. But how to calculate APR, what to include, what to not include, how to do the KYCs. These are the things I think the certain company, either RBI or the your kind of company had to come up to explain. Only the thing is explaining to the smaller NBFCs need to, this is the time where the RBI had come up certain kind of, extraordinary thought to give the knowledge or education to smaller NBFC, because they are agreed to do the compliance, but they are facing to get a right amount of knowledge, a right amount of platform where to they ask the question and get a proper reply.
Right.
So
But
we
yes,
also
Anitha.
would be in a better position if all the community of compliance offices of NBFCs stay connected, as both of you had pointed out earlier. We all should
Right.
stay connected and exchange ideas. One thing. The next thing is having a good relationship with the regulator, the regional offices of RBI. They definitely do help. And then having a thorough knowledge of all the press releases of RBI, continuously understanding what RBI wants to address to the community, the NBFC community. It gives us an enormous clarity on what is being expected from the NBFCs. So these three things, if we do, we'll definitely get some help.
Thank you. No, I think this is quite a requirement of the hour. We all need it.
Yes.
And just for just another more of a concluding remark, the last slide. I'm sure if you are falling in a base layer, sorry, if you're falling in a middle layer or upper layer in BFC, I'm sure you're aware of this notification from RBI which came on 31st of January 2024. Again, the expectation from RBI is that you need to be complying with the with all the expectations from RBI, and not just RBI. And in fact, Jailendra, you mentioned one very interesting point in the middle of your discussion about I have to be aware of what's happening at my branch level also, the compliances
Yes.
as well.
Yes.
So RBI, that's what RBI is expecting. And using the word enterprise wide, now RBI wants you to be in control and use technology. One way of looking at it, RBI is increasing my burden, but other way of looking at it is RBI is actually forcing you to use a right technology and aid to ensure you're on the right side of the compliance. If otherwise, without the circular, you had to if I have to convince my management to implement a compliance technology and invest in that would have been very difficult. But with a circular, I think it is much easier, that to sell this thought.
Right.
But idea again coming back is RBI wants their regulated entities to become tech savvy, use the technology, in the right way, in the right spirit, the way the larger NBFCs or banks are using, so that you are right on the right side of the law. Again, I'm reiterating one of the things. Down the line, few years from now, you would see a consolidation happening. If you use the technology effectively, you would see you'll be on the right side of the consolidation. If if you fail, the consolidation may take the best. So I think that's all from our side. And thank you so much, Jailendra. I think it was quite interesting. It was quite an interesting discussion. In fact, usually I talk a lot in all my webinars, but today I was more on the listening mode because a couple of thoughts, when we were sharing and Anitha was sharing, they were quite insightful for me as well. And I hope we have more such valuable sessions from you and Anitha, and we'll engage you more. And thank you, everyone.
So before, sir, just allow 2-3 minutes. I think somebody had dropped some question on chat box. If I read uh,
So just one,
they
just
are
one, just once again, Jailendra. I think uh, we would want to take, I'm sure if you all are
that's
okay.
why.
Yeah, we all
Yes,
okay.
that's why I'm saying there are some before concluding. Let's have some
We will.
questions.
Yeah. So there are queries. I think will try and answer them. Um, um, if you are all okay, we are going ahead and
Yes,
trying and taking up those
no,
questions.
no, yes,
Yeah,
please.
Jailendra, over to you. Trishul?
You're saying to me?
Yeah, so Mr. Jailendra, there is one question which says for mirror layer NBFC whether dividend can be paid out of retained earning accumulated. So prior to 50% restriction was introduced by RBI.
Yeah, so just read the para number 33 of the skill-based regulation, where the pointer is very clearly mentioned by the RBI. You just read it. This 50% dividend payout ratio is now not accepting public fund, and this no customer interference. So if you are there is no selling limit for a base layer NBFCs or NBFCs who do not have a public fund. So 50% payout ratio, yes, it is applicable. If you have there are 4 points. NPA should be less than 6%. You have not any non-compliance under the Section 45 IC of the RBI Act. The minimum capital requirement is followed by the last 3 financial year, and there is no any kind of finding by the RBI on the company. There is no qualification by the auditor in the audit report. Long-term growth plan of the company. If these are the met by the RBI, then you can do that. So just read para 33 of the skill-based regulation, which is very beautifully explained, 4 or 5 pointer only.
Okay. There is one more which says, do we have to park a separate FD for net owned funds amount for base layer NBFC and also mark a lien on it?
So unless until this FD requirement from the, if you are not received the license, once you receive the license, parking fund on FD is not required. And also parking fund in FD and not doing any other business is not considered a financial activity. Once you receive the license, you have to do the other business. Fund in FD, it is not considered your business activity or NBFC activity. Parking fund on FD, taking the OD from the FD, doing their business is a normal course of activity. Many NBFC or many HFCs is doing. So it is it is considered into a NF requirement. But prior to getting the license, your FD should be clear kit. There is no lien mark on your FD. Post receiving the license, you can do it. Take a OD from against the FD. Do your natural business, and that amount is considered to a NOF.
Okay. So also the one of the person is asking, so this RBI circular on credit issue institution sending alerts through SMS, email customers while submitting information to CIC regarding default. So one of the NBFCs submitting the credit information with NESL, and they are also sending alerts to customers regarding this. So whether this case, in this case, NBFC has to send alert on submission with CIC?
So not required. I don't think so. I'm not properly understand. If I understand this DPD related, I think they're asking the question, submission, sending alert or message, it up to you. I don't think so. There is the CIC's direction is saying sending message to the customer or alerting through SMS or WhatsApp or email. It is how you educate your customer on the DPD, how you going to do your collection, and the sharing of data with NESL or information utility. It is the once you submit the record, on IU portal, then automatically one message or email goes to the customer that you certain NBFC had updated your record. Kindly go and check the detail and accept or reject whatever. So NESL has that facility. CIC don't have such, I think, facility. Yes, if there is dispute by the customer raised on the CIC portal, then there is a certain link or SMS come to the company to resolve that issue within a defined timeline. I think this is month of February, they had come up with a certain timeline. And the penalties also, if the grievances is more than 30 days to unresolved.
Jailendra sir, actually the question of the person is relating to the circular on the that came for all the NBFCs. The requirement was to uh, send alerts to customers while submitting the information of DPD to the credit information bureaus. So actually, what could be done and what is widely done in this case is while sending the bounce SMS, the OD SMS, or any SMS that's periodically being sent to the customers, those who are having overdues, along with the SMS, you can add information that the data relating to your DPD or overdue would be submitted to the credit information bureaus. So they just the regulator just wants to give information to the customer that their delay payment is being reported to the credit information bureaus. That is the requirement, and it is being widely done. This can be sent separately along with other SMS that is being sent to the OD customers.
Okay. Yes. Next question.
So the next one says, so physical visit is mandatory for customers before onboarding if the company is doing KYC digitally?
Not required. It is your credit policy and it is your KYC AML policies, how you comply with the digital lending digital guideline. If you made all the point of digital lending guideline and also the circular which is come in the positive confirmation, the amendment in the KYC direction in May 23. If you follow it, then physical verification not required. Certain businesses, that's why I think certain kind of business, like you are in a housing finance company. So without meeting a customer, it is not possible to carry out the business. So you need to do. But if you are NBFC doing a personal loan, vehicle finance, or a kind of CD product or a gold product, it is your KYC policy how you do the KYC. If the customer not require, if you do proper doing the Aadhaar based OTP or a video KYCs or any other mode of KYC, then physical visit will not require. It is up to how much level of
Nowhere it is mandated. Nowhere it is mandated, as Jailendra sir said. You just have to follow the requirements of what a digital KYC process, or you just have to carry out sufficient level of credit appraisal and KYC appraisal so that there is no loopholes or areas that could result in lapse of the appraisal process.
Yeah, just adding here that some of the NBFC who are just starting are kind of, they are saying, I am a fintech NBFC or into a base layer or just very small. They, what they do, they follow 50% of digital. They just take the data from the customer through some mobile app or through website portal to verify their credit through the backend, and they sell the product through SMS or WhatsApp. Now on your KYC, you are eligible for this much of loan, this much of less or a PL or vehicle loan or loan against FD or loan against insurance policies. So you, before offering something, before doing the KYC, you need to follow the digital lending KYC. After the KYC or after the verifying his PAN card, Aadhaar card, or his geolocation, you need to explain what you are, which company you are. I don't know, suppose XYZ platform is there, but I don't know which NBFC offer me this loan. So you have to properly, if you're doing the digital onboarding of the customer, proper disclosure needs to give on the first basis. They say, no, we will disclose at a time of loan sanction or at a time of disbursement, but the customer need on a first hand basis. When I am doing my KYC, I need to know which are the NBFC I am going to apply, which are the housing finance company I am going to apply through the portal. There are a lot of aggregator, there are a lot of fintech who are doing the co-lending with multiple NBFCs. But the customer lender, we don't know unless until I my KYC get fulfilled, loan gets sanctioned, loan disbursement, at that time I know to XYZ NBFC are granting me the loan, and their charges were different. Some of them, so you have to properly, give a disclosure. I think you just properly read the intent behind the digital lending guideline of the RBI. It is not saying ki you just onboard the customer and after a certain time say ki ye NBFC ne nahi loan diya, some other NBFC are going to give the loan. Their charges are different. Suppose I am having a platform, some of the fintech platform. I have a co-lending in 5 or 6 NBFCs. If my profile not suited with NBFC 1, you by your system you jump to NBFC 2. The charges of processing charge, insurance charge, GST, XYZ different from 1 to 2. Is customer aware about this? No, customer not aware about this. So that's why the RBI come with the penalty. That's why the expectation from the RBI is a proper disclosure, transparency to the customer when they were doing the KYC. I am not the customer of NBFC A, but my KYC flow to them. But after the flowing to the, I become customer of NBFC 2 or 3, but my KYC flow to everybody. I know this is the Jailendra, Shukla, they are going to flow. And you store the two data. Many NBFC what to do, they start calling me. I don't know why, when I submit a KYC to you, when I doing the KYC with you, but that's the issue of the RBI. That's the intent of the intent behind the lot of direction, notification, clear disclosure, transparency, and data security. It's a major 3-4 points in the digital lending.
So to put it shortly, if you are required to go physically and verify certain things, the concept of digital lending itself is getting defeated. So
Yes.
that won't be required.
So
All
I think
right. So yeah.
no, I think Pratishal, I think we should
Okay.
wind it up here.
Sure.
What we should do is, Rishal, I think you should just note down all the queries which have come in. Jailendra
Right.
and Anitha, I would seek your help in possibly penning down the responses to these queries. We would and we will come
Very.
up with an FAQs for all the queries, because I'm just realizing it's already 4:50. We've way past our scheduled timeline. So I think we'll wind it up here. But thank you so much, Jailendra. I think you and thank you so much, Anitha. I think you both have been very patient. And one thing I would really want to appreciate is 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 your intent to go into depth and really answer, trying to resolve what's been asked and give an answer to what's been asked with the right set of examples, with the right set of references to the circulars and from RBI. This was quite helpful, and I again look forward to more sessions, because more and more I think we start talking about RBI. I think more interest you start developing into it, and more queries. And I think Bhavi still has, she just raised one query. I think Bhavi will address that in the FAQ. But I think we'll do more of this guys, and I look forward to have you
Sure.
back again.
Likewise,
Thank
you.
Mr. Jayant. Yeah, thanks for the opportunity. And unfortunately, I had some issues with the camera and connectivity in between. Anyways, it was a very fruitful webinar discussion, and it was nice connecting with all of the peers. Thanks for the opportunity again.
Yeah,
Thank you.
same here. Just adding that it's good opportunity for me also, and good to know, and giving my whatever experience I have on theoretical basis also, on the practical basis also, and I love to be part of next whenever required by the law orbit. I think it's good overall, very good experience and good learning also. Thank you so much.
Thank you. Thank you, everyone.
Thank
And we would,
Thank
we would upload these the recordings also onto our YouTube channel. Akshit has already shared the links of the YouTube channel on the chat box. If you have not subscribed, please go and subscribe so that you are intimated the moment it is onto, the recordings uploaded there. Because I'm sure there are a lot of data points which got discussed today. You may want to refer back, and it'll be easy and handy for you all. Thank you so much. Have a good day and a
you.
good weekend.
Thank you.
Thank you,
Bye-bye.
everyone.
Thank you.
Thanks.
Bye.